So in this video, I'm going to be talking about the trade setup and the times of the trade, the tools that we need in the trade, and the indicators or the settings that we are going to be using in this setup. So first of all, I'm going to be starting off with the indicator that we are going to be using is this one Lux Algo Sessions. So you can just copy and paste these exact same settings. So all of the other sessions are going to be turned off and the session A and session B is going to be turned on, and these are going to be the timing for it. So for reference, the London session is going to be from 2 a.m. to 8:30 a.m. New York time. Remember, every time that I tell in this video is going to be according to the New York time. So after 8:30 to 12:30 p.m., there's going to be the New York session. So the idea of this setup is going to be we are going to be waiting for the price to create a range between New York. We are going to be waiting for the price to create a range inside the London session, and we are going to be waiting for the liquidity sweep after the London session. And then when the liquidity sweep has happened, we are going to be waiting for the price to create a break the market structure. So when the market structure shift is going to be happening, after that we are going to be entering off of a fair value gap or a Fibonacci retracement level. So for instance, the levels for the Fibonacci that we are going to be using are going to be these ones. So you can paste these exact same Fibonacci levels as shown in this video. So you can copy and paste these exact same Fibonacci retracement levels on your chart as well. So as you can see right over here in this example, the price is creating a range in this London session, and then there's a liquidity sweep after this. So the liquidity sweep, how are we going to identify that this is the liquidity sweep? The liquidity sweep should not just be below this session. So you are going to be looking for the previous daily low and previous daily session. So if the price has broke the previous daily low, then there is residing liquidity on the previous daily highs and previous daily lows. So if there is a previous daily low or high closer to that, then we are going to be also looking for that as well. So when the price is going to be taking out the liquidity, it should not be just one candle taking out the liquidity and then going back up again. So you're going to be waiting for the healthy retracement like so. So this is not going to be a valid liquidity sweep. When the price has took the liquidity from the London session, then we are going to be waiting for the price to create a market structure, and then we are going to be waiting for the price to break the market structure shift. So this was the same example that I shown you on the previous video, that I have shown you in the previous video. So this was the video or the market structure shift. So after that, the price had took the liquidity. So then we are going to be marking out our lower lows, lower high, lower low, lower high, and then there is the lower low, and there is another lower high. This lower high is going to be confirmed when the price is going to be breaking previous lower low. So this lower high is going to be only confirmed when the price is going to be breaking previous lower low. So after the price has broke the previous lower high, right over here, the price broke it. So it's going to be only confirmed when the price is going to be breaking this and closing above the lower high. So a candle should close above the wick. So if the candle has closed above the wick, then it's going to be confirmed as a market structure shift. Otherwise, it will not be considered as a market structure shift. So after that, we are going to be looking for two to three things. So first one is we are going to be looking for the fair value gap, and second thing is we're going to be looking if there is no fair value gap. So in this example, this is the fair value gap. So for instance, if you don't know what is the fair value gap, the fair value gap is going to be a imbalance between three candles. So as you can see right over here, this is the first candle, this is the second, and this is the third candle. So the area between these, the imbalance between these three candles is going to be this one, this candle right over here. So it is going to be the fair value gap for us in this case. So we can take a trade from this fair value gap like so, and our stop loss is going to be just below the swing low, and we're going to be targeting the residing liquidity on the other side. So this is the first example of entering into a trade. The second strategy or the second thing to keep in mind is to plot the Fibonacci retracement tool. And as you can see, the 0.618 level, the golden Fibonacci retracement is aligning up properly with this fair value gap. So it increased the probability of the price reaching out to this level. If there would be a zero point 0.5 level on this fair value gap, then I would be looking for sure that if it price is going to be confirming, price is going to be retracing to this fair value gap. So you can either use these levels and place your entry at the Fibonacci retracement tool, or use the fair value gap as your entry point. So in both cases, you are going to be targeting the recent or the closest residing liquidity. In this case, the closest residing liquidity is above here. So if you don't know what is liquidity, liquidity is going to be residing orders on the previous lows and highs. So in this case, the liquidity is residing up here, and we have entered the trade right into this area. And as you can see right over here, this trade was a win. So it almost came back up here, but didn't took the liquidity from here because it was creating more liquidity on this area. And when the enough liquidity was created up here, then the price took the liquidity from this session, and also the price also, I think, took the liquidity from this lower highs as well. So this was a prime example of a trade of a long setup. So the short setup is going to be exactly the same as I have shown you in this example. So as you can see right over here, so just ignore these. So it's going to be a little different on the real chart, but I'm just going to be telling you how you can enter into the trade. The price is going to be creating higher highs, higher lows, high high, high low, and then another high high. And then when the market structure shift has happened, as you can see right over here, this was a lower high and another higher high. Sorry, this was another higher low, and this was a higher high. And when the price broke this higher low, then there is a fair value gap and all of those things that I mentioned earlier. So when you are plotting your Fibonacci retracement tool, remember that you are gonna be plotting it from 1 to 0. Always you are gonna be plotting from 1 to 0, and you are gonna be start plotting or connecting first the swing points of the retracement. So in this case, the price is gonna come back up and fill up this fair value gap and then go back to your TP. So this is going to be the exact same settings for the short trade as well.